Good afternoon. My name is Richard Glover. I'm chairman of Albion Crown VCT, and it's my pleasure to welcome you to the company's annual general meeting. Alongside me today are my fellow directors, Pam Garside and Ian Spence, as well as Anne Beresford and Richard Wilson, who were previously on the board of Albion Venture Capital Trust PLC, along with myself. Now, we were going to be joined today by Will Fraser-Allen, the managing partner at Albion Capital, who always does his very informative presentation on the results for the previous year, in this case, the year ended June 25. Unfortunately, Will has had to go to hospital this morning with an issue with his eye, and he is unable to join us, which is most unfortunate. We do wish him a speedy recovery, and we have been assured that when he has recovered, he's going to record his presentation and make it available to all shareholders on the Crown webpage of the Albion Capital website. The information that will be contained in the presentation can be found in the annual report and financial statements that have been sent to all shareholders. So obviously it's very unfortunate not to have the presentation today, but we are still able to continue with the formal business of the AGM. And I'm very pleased to say that we have been joined by Robert Whitby-Smith, who is a partner at Albion Capital, who will join me for a question and answer session later. So, if you want to answer a question, please select the Q&A icon from within the navigation bar and type your question at the top of the screen. Click on the arrow icon to the right of the text box and submit your question. Before I move on to the formal business, I would just like to say a few words on the merger which came into force on the 19th of December 2024, following approval by shareholders at respective general meetings of the companies in December 2024. And I would like to thank both the directors and Albion Capital for all the hard work that was put in, which led to a successful merger with Albion Venture Capital Trust. And I'm delighted to welcome Albion Venture Capital Trust shareholders to the company. The merger is designed to bring, and is already bringing about, a number of key benefits, including cost savings to shareholders, simplified fee structure, and reduced administration through holding investments in one VCT. And I look forward to working with the directors to bring continued success to the company. Moving on to the formal business, the quorum for the AGM is 2 members entitled to vote in person or by proxy. I can confirm that this has been met. I therefore declare this AGM open. The notice of the meeting has been in your hands for the statutory period, so I'll take the notice as read. To maximise engagement with shareholders, the board have again arranged for the Lumi team to broadcast this year's AGM using its online platform. And this enables members to interact fully, including taking part in a Q&A session and voting on the board's proposed resolutions. Let me just explain how the voting process will work, but I should first say that if you have already submitted a proxy vote to the registrar, you don't need to vote again unless you wish to change your vote. The resolutions will be voted on by way of a poll. The votes received under this process will be added to the proxy votes that have already been received and verified by your independent registrar, Computershare. Once I declare the poll open on the Lumi platform, a list of resolutions will automatically appear on your screen. Please select the option that corresponds with how you want to vote, and the option will change colour, and a confirmation message will appear to indicate that your vote has been cast and received. To vote on all resolutions displayed, select the Vote All option at the top of the screen. If you want to change your vote, you have the option to reselect your choice. Should you have any questions on the voting procedure, please send them through the platform and someone in the Albion team will respond promptly. I now declare the poll open. So, in the absence of a presentation, we will now invite questions from members on the company's financial results and the proposed AGM resolution. And I would like to thank those who've already submitted their questions and queries through the chairman email address and via the messaging function. So just to begin with, we have had a number that have been submitted in advance, and a couple have come in on the director's remuneration report. The first is that at the last AGM, it was reported that 97.8 votes were cast in favour, 2.2 against, and 0.2 withheld. And the question says, obviously, those figures don't equal 100%. Is that simply because the numbers have been rounded? It's not, actually. The figures don't add up to 100% because they refer to different populations. Of the total pool of people who voted, 97.8% were cast in favour and 2.2 against, and there's your 100%. Separately, there is a requirement to present the number of votes that were withheld, and that figure equates to the 0.2% of total voting rights. If that was somewhat infelicitously expressed at the last in the report, then we'll look at that for the next one. And another question about that report relates to the figures for total remuneration in the last year of 126,000, and that in 26 year the figure is forecast to be 138,000. And the questioner points out that's a 9.5% rise. Can you explain this in a bit more detail? Yes, this is due to the fact that at the time of the merger, the board went from 4 to 5 directors, and so there was actually less remuneration paid in the total in the year of 2025, but in the forecast for 2026 it assumes that the current directors will remain in the positions for the full year, so that actually accounts for the difference. Should just be clear that there have been no adjustments made to the level of remuneration of the directors, and at our recent remuneration committee that was confirmed, and it will stay with the 3-year cycle that we already adopt. So the next question, which 48 or 48 hours ago we might not have expected, but we certainly expect it now. The Chancellor has reduced the tax reliefs on investing in VCTs 20%. How will this impact the VCT? And this is where I turn to Robert with his crystal ball. Robert.
Thank you, Richard, and welcome everyone. So I think there are two key changes announced within the budget. One was that the limits and tests supplied for VCT investment have increased. Those limits haven't changed for about 10 years, but essentially they're doubling both the amount a VCT and an EIS investor can invest in a portfolio company in any 1 year, and also over the lifetime of a portfolio company. Now these have been requested by industry, and we're very grateful to Government, Treasury, Chancellor for showing support for these important interventions to support scale up capital in the UK. So that's really positive development. Alongside that, there was the announcement that there will be a reduction in that initial relief of income tax starting from next tax year. So it won't affect this current year's tax funding environment. I won't speculate as to how it will affect future years at this point in time, but I can announce that the Treasury have announced a consultation with the industry on these on this particular change, and we very much look forward to taking part in that consultation.
Oh, thank you, Robert. Yeah, it came a bit out of the blue, but as you say, we will be thinking about that and the implications for the longer term as time goes by. Don't go away, there's another one for you here. The circular said that the reason for the new C share class was, in quotes, given that Albion Crown has a greater exposure to more mature technology investments within its portfolio, the different share class will allow the maturity profile of both the target and acquirer portfolios to become more aligned before the conversion is effected. And the questioner says very little alignment seems to have occurred. What alignment has occurred, and has the alignment process been a success?
So essentially, Thank you, Richard. So essentially, the average holding period for a VC investment is around 7 years. By allowing a number of years, and so the merger date, I believe, is June next year, it allows particularly younger portfolio companies another 2 years of maturity. There has been progress among in both portfolios during that year. In fact, the growth of the overall portfolios is very exciting, and there's another year of growth to go. So we're pleased with the progress to date, and look forward to that further progress in the next year.
Very good, thank you. The next question is about this meeting, and the questioner says that they believe there should be a physical AGM and not a virtual one. And can we provide comment on the discussions that the board has held on this issue? Yes, certainly. We do spend a lot of time thinking about how best to communicate with shareholders and how best to provide the appropriate experience to 11,500 people, individual holders based all over the UK. And we want to make sure that they get the best possible experience at a reasonable and sensible cost. And what we have established since we started having virtual AGMs is that we've actually got far better attendance and engagement than we ever had from physical meetings in the City of London. And so our conclusion has been that virtual AGMs are a success and that they are appropriate as the best means of communicating with the broad base of our shareholders. What I would say is that we do have, in fact, we had it very recently, the in-person shareholder seminar, and that gives shareholders the chance to meet with members of the board and with the executives of Albion Capital. And we had a couple of portfolio companies presenting to that. It was a really good event. And again, personally, I can say that I spoke to a number of people who said that this was the event that they valued much more. And with very few exceptions, there seems to have been an acceptance that virtual AGMs are the right way forward. Now, we had another couple of questions on how we value our investments. And the ones mentioned here, notably the two top investments, Quantexa and Gravity. What information do we consider when valuing investments? Robert, do you want to pick that up?
Thank you, Richard. I guess one of the most important pieces of information when we're considering valuation are the prices at which independent third parties have been subscribing for shares. And actually, in both those instances of the top two holdings, we've had third parties subscribe substantial sums of money for new shares into those companies at a share price. And our valuation is reference to those. So, for example, in Quantexa, in March this year, 2025, they raised approximately $175 million from Ontario Teachers Pension Fund, and we're able to reference that in our valuation. And for Gravity, in June this year, 6th Street, which is a large New York-based investor, led an investment round of approximately $60 million into Gravity, and so we're able to reference that. In terms of the information, we obviously that was at a point in time, March and June. We have access. We typically sit on the board or observers on the board. We have access to management accounts. Often we have access to current snapshots of trading performance. So we have almost real-time information on the trading performance of our portfolio companies, and we factor all of that in. I'm pleased to say in both those instances, the companies continue to trade very strongly since those investment rounds, and we think those are that in terms of how you can value private companies which aren't publicly traded. Third parties subscribing recently is a very strong form of evidence.
Thank you, Robert. And yeah, on behalf of the board, I can assure you that this is something we do take a great deal of interest in. The whole question of valuations is something that we look at on every time we get together, and it's always a very live issue. And the points that Robert makes, I think, are very important in our considerations. So here's one we probably could have anticipated, a question about AI. And how is AI impacting the portfolio? And is it a threat or an opportunity? This is the $64,000 one for you, Robert.
Thank you. Thank you, Richard. So I've been investing in software and technology for over 20 years now. And I can genuinely say it is the most exciting time to be investing. And we've been investing in AI for some time as well, in the incarnations of machine learning, reinforcement learning, etc. But what everyone's very familiar with is in the last 3 years or so, AI in inverted commas has gained an understanding and an ability to create language, a human language, and that is a force multiplier in terms of what can be automated and what is possible to innovate in terms of scientific discovery, etc. And this is, I don't think anyone would deny, this is going to be an industrial revolution. And for us, I guess one way we frame it is we're trying to find the picks and shovels for this railway boom. And we are super excited by the companies we've backed and the companies that we continue to back. The AI tooling is available to all our portfolio companies to enable them to build faster, scale quicker, distribute quicker, and leverage new discoveries and innovation. And I'll also add, I think the UK is very well placed to take advantage of innovation, given our incredibly strong universities, the entrepreneurial founding talent that's available, and the funding environment that's very strong for founders and entrepreneurs at early stage. So we couldn't be more excited. I think is probably the best summary. But to quote Andrew Groves, founder of Intel's great book, "Only the Paranoid Survive," one must focus, on both sides of the question.
Thank you very much. Thank you, Robert. Very neatly put. I think that is all that we have. I don't think we have any other questions coming through. So we can now continue with the formal business of the AGM. The full text of the resolutions were set out in the notice of the meeting, and the board is recommending that members vote in favour of all the resolutions, and I'll briefly summarise these. First resolution is to receive and adopt the company's accounts for the year ended 30th of June 2025, together with the strategic report and the reports of the directors and auditor. Second resolution is to approve the directors' remuneration report for the year ended 30th of June 2025. The third resolution is the re-election of Pam Garside as a director of the company. The fourth resolution is the re-election of Ian Spence as a director of the company. The fifth resolution is my own election as a director of the company. The sixth is the election of Anne Beresford as a director of the company. And the seventh is the election of Richard Wilson as a director of the company. The eighth resolution is the reappointment of Johnson Carmichael LLP as auditor of the company to hold office from the conclusion of the meeting to the conclusion of the next meeting, at which the accounts are to be laid. The ninth resolution is to authorise the directors to agree the auditor's remuneration. The 10th resolution is to allow the directors to allot new shares. The 11th resolution is to approve the renewal of the company's dividend reinvestment scheme for ordinary shares and authority to allot ordinary shares under the scheme. And the 12th resolution is a special resolution to give the directors the power to disapply preemption rights. The final resolution 13, which is again a special resolution, is to authorise the company to make one or more market purchases of ordinary shares and/or C shares in the capital of the company. The results of the voting, including the proxy votes on each of the resolutions, will be announced after the AGM through a regulatory information service announcement. Additionally, the results will be published on Albion Capital's website as soon as is reasonably practicable. I confirm that the voting has now finished, and I now declare the meeting closed. In the meantime, I will show on screen the current proxy votes that have been received by the registrar. As you'll note, the proxy votes are comfortably in favour of the proposed resolutions. Thank you. That concludes the business of the AGM, and I would like to thank all members who joined this AGM by webcast. We would welcome, I say that in the right, that we welcome any feedback you may have, and you can do that by sending an email to me at crownchair@Albion Capital. I would now like formally to close the AGM. On behalf of the board, thank you for joining your company's AGM. Thank you very much.
Let me start by giving a bit of background as an introduction to the rest of the presentation. I don't think I'll need to remind many of you that we still live in some slightly unusual times, and that really is both on a global but also on a domestic basis. So we have this sort of combination of ongoing sort of geopolitical issues globally, whether that's Ukraine, whether that's the Middle East. But also we do have a few things that we need to think about in the UK, not least low growth. Inflation, whilst falling, is still somewhat higher than target, and we still have interest rates higher than normal, but hopefully coming down. Just to set the scene for how I'm going to present the financial numbers in this presentation, it's worth just reminding ourselves that of the merger that happened in December last year. This was when the Albion Venture Capital Trust PLC shareholders joined Albion Crown by means of the creation of a new class of shares, which are described as the C shares. So effectively, the assets of Albion Venture Capital Trust were acquired by Crown VCT, Albion Crown VCT, but they've been segregated in a separate class of shares, and that was done to enable the two portfolios to converge over time. So what that means is that in November next year, we expect the merger will finally happen based on the 30th of June numbers. So effectively, as we present this set of results today, I am casting my mind forward, looking at what the company would look like as if it had merged in a year's time, to give you, the shareholders, a feel for the direction of travel and what ultimately the company in which you invested will look like. Overall, the results are behind where I would ideally like. We are showing small losses for the period. However, let me talk you through some of that, and a reminder to everybody that when considering the performance of a venture capital portfolio, returns are not linear, and you should be looking on over the mid to long term in terms of appraising performance, because upside is often driven by one-off events such as large exits or large fundraisings. So this is the balance sheets presented for each of the two classes and then combined. So what you can see is that the size of the overall company, which is what it will broadly would look like if the next year's merger had already happened, shows net assets of 170 million. So that the company is somewhat larger, and the cash across that combined two portfolios sits at about 38 million, but it is somewhat lower in the C shares, and worth just reflecting on that for a moment. That is because they have not raised money for a couple of years. Here are the results. All these slides are busier than I would ideally like. So top line being the ordinary shares, the second line being the C shares. Both are showing small losses for the period, and we'll talk about what's driven that. Both have continued to pay dividends, but both have decent longer term track records. In terms of that track record, you can see the impact of a trickier period And I am going to talk in more detail about the C shares because, as you see, we've had a difficult period over the last 12 months. Now, part of that return is when they were an independent company, Albion Venture Capital Trust, and then the balance is when it became a merged entity. On the ordinary shares, you'll see that on a 10-year basis, we're still well above our 5% dividend target, although on the C shares, we have now dropped behind that. So looking at the sort of highlights across both share classes, the ordinary shares had a successful fundraising. C shares didn't raise, and then in terms of exits, they've mostly happened within the ordinary shares, and that's specifically the sale of Egress and Locum's Nest. Investment has been very much focused on the ordinary share pot, where there is more cash. So you see 9.5 million invested there. C shares were rather less at 1.4 million. Share buybacks continuing with our strategy to target buybacks at an approximate 5% discount, and dividends similarly in line with our dividend strategy of paying around 5% of NAV. Looking at the ordinary shares alone, the key drivers of value have been the uplift of the Viva. This is our healthcare company, which provides a platform for dietitians to provide treatment, particularly to those suffering from diabetes. That has seen very strong growth, particularly as they've moved into supporting weight loss programs through GLP-1s. So this is where somebody might be taking anti-obesity drugs, but they need the support of a dietitian. This business is growing extremely fast indeed, not only in the UK, but across Europe. Similarly, Gravity saw a decent uplift following a substantial fundraising in the year, and Converter has won a very significant client in the year, which has driven strong revenue growth there. I'll come back to Radnor House in a moment when we talk about C shares, but looking, we have seen Provica come down a little bit. This is our pediatric medicines business, and that is down to the slower rates in terms of in terms of selling new products across Europe. And then we have had some challenges at Nouveau Air where they suffered in a very difficult fundraising environment, which led to a significant write-off there. The other ups and downs, and there are a number of them, are in the annual report. So looking at the C shares, this is where we've had some challenges. On the positive side of things, Gravity, which is also in the ordinary shares, has done well, as has Elliptic and Transfic. And that's helpful because what that is showing is that the technology element of the C share portfolio, and remember, the C shares started investing in technology relatively more recently. So what we're seeing is that what we were looking to see, which was that technology portfolio beginning to mature prior to the merger with the ordinary shares. It too was an investor in Nouveau Air. But where we have seen some challenges due to issues outside our control is the Kew Green, which is our Stansted Hotel, and Radnor House School, both of which are linked to government policy, particularly around taxation. So hotels are finding it particularly difficult with the big increase in national insurance that was announced in the budget before last, and big increase on business rates. So despite revenues growing there, costs are growing rather faster, which reflects our underlying valuation. And Radnor House School, which is our independent school down in Sevenoaks, has been hit by the decision of government to add VAT on school fees, and they too, because of a key cost for them is their staff, have been hit by the higher national insurance costs coming through. So those are linked very much to government policy around taxation, which is what it is, but it is clearly disappointing from a perspective of delivering shareholder value. And similarly, there's various other ups and downs that can be seen in the annual report. busy slide. What we're trying to do here, and as we've been asked by a number of shareholders to do, is to provide a bit more granularity about the sectors in which we're invested. So we've split out particularly the software sectors into more subsectors to give you a feel of where we're invested. And because I'm thinking not only about the individual portfolios now, but I'm also thinking about what the portfolio will look like on a combined basis next year. We've given you both sets of numbers, but the broad theme remains the same, that there is a significant and growing exposure to software across fintech, AI and data, digital risk, climate tech, a small exposure to deep tech, which is an area that we want to grow in a measured way over time. And then we continue to have an allocation to healthcare, particularly health tech. Renewable energy is coming down, as we would predict. That is a sector that provides useful income flows each year towards paying the costs of running the fund. Cash, as I've alluded to earlier, is higher in the ordinary shares, which has had an active fundraising in the last couple of years, whereas the C shares has come down prior to the merger because there haven't been fundraising. But the cash is being managed, and one of the ways we've managed it, as the board has previously announced, is that we have reduced the ongoing investment program to reflect the cash position of the business. Similarly, looking at the sort of how the portfolio looks from the point of view of maturity, as you can see, the C shares have a lower exposure to early stage, but also has a lower exposure to scale up. So you can see the two portfolios becoming complementary over time. And if you look at how they might look on a pro forma basis, this very much is now looking like a typical Albion fund, where you have sort of around 10% or 13% here in the early stage. And as I have said before, that's the important driver of the future growth companies that you see in the next two categories. And then what's encouraging here is that we've now got a significant exposure to what we call scale-up companies, which is the more mature category with revenues of over 5 million. And that's on a combined basis is now sitting at about 75%. So very much sort of this portfolio post-merger will look very much like you would expect from an Albion portfolio. Lots on here too. This is our slide where we just give you a sense of the top 3 companies in the 2 portfolios. So if you look at the ordinaries, that's Quantex, which is our data analytics business that detects financial crime, mostly in large banks. Aviva, that we've talked about earlier, and then Gravity is a top 3 company in the ordinaries, but it is now also the largest company in the C shares, and that is our business that manages APIs, which is the application, which is the how software communicates with each other. So what you're seeing is we now have got to a stage where we have one of the technology companies has now grown to a stage where it features in the top 3 of both categories. If we look in the C shares outside, you'll see the second is one of our hydro schemes, but number 3 is also now a technology business, which is Elliptic, which allows companies involved in crypto assets to detect detect money laundering. New investments. So this is very much focused on the ordinary shares, which had more cash. And just a few examples here. Avaro was within our healthcare portfolio, which is using a platform to allow more people to access healthcare online. That's growing very fast. We've got Labris, which is our first exposure to the defense tech sector. We've got within our deep tech exposure, which is embryonic at the moment. We'll look to grow at time. We have Latent, which is using AI to make animation within computer games both more effective but also significantly cheaper. And then Iron8, which is providing a more effective transformer with a software overlay to assist in the electricity transformation that is going on, and allowing the grid, which has got to now manage multiple sources of generation, particularly around renewables, do it more effectively and more efficiently. And then finally, open trade, which is providing the ability to deliver yield product to those that are holding a particular type of crypto asset, which will benefit from that, and that's known as stablecoin. Just so that everybody's aware, we are currently fundraising. So we're fundraising in the ordinary share class, but bear in mind that is a class that will merge with the C shares next year, as we've described. We're currently looking to raise 60 million. If people are interested in that, then all the details are available on our website. And I would encourage everybody to make sure they have read the prospectus before making a decision to invest. Minimum investment 6,000, and then the most you can invest in any one tax year and get tax relief is 200,000. Lots of information about that on our website, and the Albion team will be very happy to talk you through what we're proposing there. I know many of you will have been following the recent budget, the 2025 budget. That had more about VCTs in it than both I and indeed many industry commentators were expecting. So let's start with the positives. One of the things we've been asking Treasury to do, and indeed government to do, is to allow VCTs to invest in more companies and invest for longer in the ones that they do. And this was all around loosening some of the rules that limited the amount of money we could put in each year to a company, and indeed over a lifetime. And as you can see here, they've doubled those limits. So that's helpful. That gives us more flexibility. That increases the population of companies that we can invest in. But really importantly, and why we were keen to do it, is to make VCTs more relevant to helping the companies scale up and become larger. So that will allow us to back our best companies for longer. So that's very positive, and very, very much welcomed by Albion and the industry more generally. And we would hope that in time that should give rise to the potential for better outcomes for investors. What was what was more of a surprise but less helpful was the announcement that they are going to reduce the initial upfront tax release from 30% to 20%. We are currently engaging with Treasury to discuss this, because clearly this would reduce the amount of fundraising that the industry will do at a time when we're being asked to do more. But helpfully, the Treasury have issued a call for evidence where they have asked for input from the industry on how this might impact the effectiveness of the scheme, and effectiveness in the sense of supporting companies, and also asking for ideas around how the scheme can be improved. So this provides us with an excellent opportunity, and indeed Albion will be at the forefront of responding to this, so that we might engage with government with an ambition to see whether longer term that upfront tax relief could be increased. In the meantime, we feel that the proposition is still very strong. At the end of the day, the huge benefit of VCTs is actually in the tax-free income. And whilst the upfront tax relief is helpful, the real value over time is driven by that ongoing tax-free income stream, which is very difficult to replicate in other environments, particularly if you have fully utilised your ISA. So lots to think about there, lots of work to be done. Good news, but obviously also areas that we want to work with governments to see whether we can improve going forward. Looking at our first quarter results, we have seen another couple of small losses. for both share classes, particularly well, as I hope you've seen from some of the earlier slides. There are some interesting technology companies coming through in both share classes. Dividends announced on both classes, 0.76p on the ordinaries, 1p on the C shares. And then we also announced that we have had our active and ongoing disposal program has seen a number of successful exits. So Excellex has sold at 1.7 times cost, Evewell Group at 2.8 times cost, and indeed with an earnout, Evewell's return could increase to 3.2 times. So very helpful that we are seeing disposals coming through, both in terms of generating returns, but also bringing cash into the portfolio, which ultimately is how we pay dividends to you, the shareholders. Just a quick reminder, the C shares merge with the ordinary shares next year, probably around November time, but it will be based on the 30th of June 2026. Nothing that you need to do, that happens automatically, but hopefully I've been able to give you a sense today of what that merged entity might look like when that merger goes through. Looking forward, this is sort of broader prospects across both share classes. Look, we do still have uncertainty. We still do have questions and marks around how strong economic growth will be in the UK. But we will get on with what we are meant to be doing, which is building a balanced portfolio of high growth companies that are focused on mission critical products and services, which should over time provide resilience. We do target limited exposure to discretionary consumer spend. That should help with volatility and difficult economic times. And importantly, the combination of the cash that we currently hold, particularly in the ordinary shares, the fundraising that we are currently undertaking, will mean that we are well positioned to capitalize on new investment opportunities. And encouragingly, the investment team are seeing a very, very strong pipeline of both new investments, but also the opportunities to back the successful companies within our portfolios as they grow.